H. Kumar, the Managing Director of MRPL, and Amit Rustagi of Antique Stock Broking joins in from the conference. Good afternoon, gentlemen, and thanks so much for joining in. Mr. Kumar, my first question is to you. Since the last time we've interacted, we've seen a similar fall in crude prices. So how does it impact, your company, and what can we expect from your gross refining margins going ahead?
The crude prices have been coming down, which is common knowledge now. And, it basically affects us on the inventory losses. If you look at our core GRMs, we have been doing quite well. Loss in inventory has kind of offset most of it.
Would you look to book all your inventory losses in Q3, or would you look to spread it out over Q3, Q4?
What we do is, each quarter you have to book the respective inventory loss for the quarter and the cumulative also. Yeah.
Okay. All right. Mr. Kumar, just hold that thought. We have the PC Jewelers numbers flashing on your screen. It's a net profit of around 109 crores versus 80 crores on a year-on-year basis. Any which way, all of those stocks have been buzzing today. That is the jewelry stocks on anticipation of a possible import cut, which might be anticipated in the budget of around 2 to 3% on gold. So that's also been keeping a lot of these stocks alive. But the net profit has come in at around 109.3 versus 80 crores. So it's a bit of a spike up that we're seeing on a year-on-year basis. Mr. Kumar, just wanted to focus on the progress of your phase 3 expansion at this point in time. Where does it stand?
The phase 3 expansion is totally completed. In fact, all the units have been commissioned progressively over the past year and a half, and with the last unit, petrofluidized catalytic cracker, that unit was commissioned in the month of August. With this, all the units have been commissioned, and all units have been stabilized, and now the units are running to 100% capacity.
Okay. What's the outlook on gross?
As regards the...
Go ahead.
Yeah, we have the last unit which was not part of the phase 3, but it's a separate project, which is the polypropylene unit, which is also getting commissioned during this month.
Okay. I'll come back to my first question. What's the outlook on gross refining margins, sir, going ahead?
For the next year, we are looking at, maybe, close to $8, we should be getting.
And
close to $8, as, expected after completing the expansion and the polypropylene unit.
And in the second half of this fiscal year, for Q3 and Q4?
See, Q2 we have reported a loss, you are aware. But
yes.
The operating GRMs or the core GRMs have been around 4.39 for 4.3 odd for Q2, barring the inventory loss,
Okay.
Yeah.
Okay, we have Amit Rustagi of Antique Stock Broking joining in to talk about the oil and gas space as well. Amit, hi, good to see you in today. Well, I can't help but start by asking you about GAIL. That stock is down 3% ahead of its numbers. What is your expectations from the numbers? Is there any subsidy element we can expect, and if so, how much?
Yeah, so GAIL, if you see last quarter, they have not provided any subsidy, which came for Q2. So they have to provide 500 crores of subsidy in this quarter, which is pertaining to the previous quarter. Apart from that, there can be another 200 to 300 crore burden on GAIL pertaining to this quarter. So total we are looking at almost 700 to 800 crore subsidy burden, because of which numbers are expected to be weak. We are expecting a profit of around 450 crore for the quarter, including the subsidy burden.
450 crores?
This quarter is, yeah.
Okay, and what would your call on the stock be? How important are these quarterly earnings
our
for you?
call on the stock right now is a sell with the target price of 415, and we are witnessing that GAIL is going through a tough time because the commodity prices, petrochemical and LPG, are coming down sharply along with the oil prices. And GAIL, 50% of the revenue is coming from petrochemical, and 30% of the revenue is coming from LPG. So almost you can say 75% of the revenue is exposed to the commodity cycle where prices are declining. So this is something which is likely to be corrected once the oil prices reverse. But oil prices have to be above $70–75 for GAIL to make sustainable profits.
Okay.
Hi Amit, good afternoon. What would your call be on GAIL, and what would be the key triggers for the stock going ahead?
See, the key triggers on the stock ahead is the recovery in the petrochemical and LPG prices, which is not in sight as of now because oil prices are still hovering below $60. So these are the two segments which have been contributing almost 65% of the profitability of the company. Last 2 to 3 years, because of higher oil prices, company has been reaping good benefits. But when oil prices have come down, the profitability of these two segments is going to be impacted. Simultaneously, they are expanding a petrochemical unit which is likely to be commissioned in the fourth quarter. And this unit is also having a higher cost of production. So today's petrochemical prices are not justifying their cost of production as well. So we are going to see very thin margins or even EBITDA loss at the new unit which is getting commissioned in the fourth quarter. So we have a reduce or sell call on the stock because of the changing fundamentals at the macro level.
Okay. Amit, I wanted to quiz you about Cairn as well. That stock has risen significantly this week, possibly on the back of the hike in Brent prices that we've seen globally. What would your call on Cairn India be in terms of earnings going through this year?
Yeah, so Cairn India also we have a sell with a target price of 190, and we retain this view that for a E&P company there are two important fundamental factors. One is the volume growth and another one is the pricing. So what relations you are getting, and we are going to see Cairn is going through a tough time in terms of volume addition. So we are not going to see a volume growth for next 1.5 years because of some delay in the approvals for their Aishwarya ramp up, and because of some cutbacks into the capex due to the lower oil prices. Simultaneously, the realizations are also getting impacted as oil prices have corrected. So they used to realize almost $100 till last quarter. Now this quarter onward, they'll start realizing say about $50, even if we give a 8% discount to Brent. So overall, both volumes are likely to remain flat and realizations are likely to decline. So we are seeing a almost 40% earnings decline for the next year, which is slightly negative for a E&P stock, and hence we have a sell rating with a target price of 190.
Okay, Mr. Kumar, one final question. You indicated that the phase 3, project has been, you've totally completed the phase 3 expansion plan. How will this benefit your financials in FY16?
That's it. The overall number on GRM, what I was talking about, around $8. Basically, the value-added, units are these PFCCs and the delayed coker unit. These are the 2-3 units which really give us the value addition. And we have got so much of flexibility now that, we can produce zero bottoms, zero fuel oil. So, which is a big plus for us. And that will give a huge fillip to our GRM numbers.
Okay. Mr. Kumar, I don't mean to catch you off guard, but there have been a lot of, old reports and new reports indicating of a possible buzz in terms of a merger between OMPL as well as MRPL. Anything you'd like to comment on the same?
I would like to not comment on that at this point in time.
Is that something on the cards?
It is okay. Yeah, we are looking at all the options. We are looking at the feasibility. We are looking at what kind of a value add will be there for both the companies. So these are being looked at now.
Okay. All right. Fair enough, Mr. Kumar as well as Amit. Thanks very much for joining in and talking to us.